I now recognize the gentleman from Texas, Mr. Williams.
Thank you, Mr. Chairman, and thank all of you for being here today. And I'm a small business owner in Texas, job creator for 44 years, Main Street guy, and in full disclosure, I'm an auto dealer. And I understand that they're squeezing you to get to me. I get it. When a new regulation is put into place or a new law is enacted, banks or credit unions have to increase the amount of resources they devote to compliance. More regulators, I'm told, are hired more by some bankers than more loan officers. While the stated purpose of these new laws and regulations is to protect consumers, the opposite is actually happening. Increasing regulation means two things: fewer products and fewer services. For example, take Dublin, Texas, the home of Dr. Pepper. Population just shy of 4,000. Bankers have told me that because of regulatory overreach, they won't make loans for homes valued at $150,000 or more, much less for $50,000 or more, which is the average price in Dublin. And who does this impact? We know who it impacts. It impacts the seller, impacts the buyer, and the bank trying to make the loan. But what about the plumbers? What about the carpenters and electricians and local contractors and hardware stores that would benefit if we sold a home? So it goes on and on and on. And regulations are not just hurting banks, but the customers who depend on them. And for the customer, relationships matter. My constituents want to bank with people who they can trust, and that's not the Federal Government. And they want to bank have relationships that are built not in a week or a month or a year, but over a lifetime. And I tell everybody in the Federal Government, being a small business owner, reputation is the most important thing all of us have at the end of the day, something that this administration just doesn't get. Now, in Texas, we're not immune to the impact of Dodd-Frank. The other day, or as we talked about, in Texas alone, and Mr. Williams, you'll probably back me up on this, we have 115 fewer community banks than we did 4 years ago in Texas. And that's an economy that's the best in the world.
Yes.
And so we had Secretary Lew here yesterday, and we were talking about Dodd-Frank, and he was expounding on how great it was and said that we'd also talked about there's a possibility that he can just with a stroke of a pen take the $50 billion guys and get them out. Even Barney Frank agrees with that. But he thinks he has to continue to get Dodd-Frank in full implementation before he would do that. And I asked him that I would like for him not to do that, because if we go that long, we could lose banks, we could lose all lending institutions, we could lose businesses, we could lose jobs. So I hope he considers that. And then there's the worry and the fervor and the fear over fair lending evaluations and the use of desperate impact as a viable theory to evaluate all this. It's reported limiting the number of banks willing to make small dollar loans. We understand that. And someone who's in the automobile business, I'm very sensitive to the idea that some think that people are given different rates based on race, religion, or gender. So I support reform in the Consumer Protection Financial Bureau's mortgage rules, but I also want to make it easier on you to be recognized for your performance and not penalized. So I guess I would ask a question, really yes or no to all of you. I want to get back to what Secretary Lew said. Should we wait for full implementation of Dodd-Frank, or should we try to reform it and get you guys out of it?
We should reform it. If it's broke, fix it. Reform it.
If it's broke, fix it. Reform it. We definitely need to reform it.
We weren't the bad actors. Reform it. Get us out of it.
And it would also help mitigate the cost to consumers that we have to pass along.
Right.
I think it really depends on the provision.
Okay. Thank you. Now, we've talked about, one of the questions I had was how much this is affecting your bottom line. We talked a lot about that. I heard a thing the other day. It says there's more. It takes more man-hours to meet Dodd-Frank now halfway through it than it did to build all the man-hours in the Panama Canal. So that puts it in perspective. We also just heard from the professor that it's hard to measure compliance cost in a business. I would think that, is that right, Mr. Miller?
That is correct, sir.
But you also might, one way to measure it is it's cutting into your bottom line.
Yes,
because you're having to hire somebody that can't loan money out.
It does cut in the bottom line tremendously.
Well, I'll be brief real quick. The economy's not fixed. I think that Main Street America is still hurting. Risk and reward is being attacked. And I guess I would ask any one of you just to respond real quick. If we reduce burdensome regulations on you all, don't you think it would help small business guys like me take risk, get reward, put people to work, get them off unemployment, and get net worth back in America?
Yes, it would decrease your cost of doing business.
All right. Thank you very much. Thank you for being here, Mr. Chairman. I yield back.